Thank you very much for joining us today. And I'd like to begin by acknowledging the traditional owners of the various lands on which we're meeting today and their ongoing connection to and custodianship of those lands, and to pay my respects to elders past and present. I extend that respect to any Aboriginal and Torres Strait Islander peoples who might be joining us today. And also, our thoughts are going out to those of you who are in Melbourne who are in the midst of the lockdown. Thank you so much for your patience in doing that. We know that we are all the beneficiaries of your efforts in really going through another lockdown. So thank you so much for that. And I will cheer you up by having a fabulous discussion today about digital financial reporting. Technologies really are transforming the way in which we're working, aren't they? And today's webinar is going to discuss the international developments for digital financial reporting and the opportunities for us in Australia. Now, digital financial reporting involves a tagging of information in financial reports on a consistent basis for analysis electronically. Now, digital financial reports are also readable by us mere humans because they have all the presentation flexibility that is available for a paper or a PDF report. But digital reports also offer the ability to navigate and drill down to relevant information using hyperlinks. Since 2010, we at ASIC have accepted the voluntary lodgement of digital financial reports, and we haven't exactly been knocked over by a rush, disappointingly. There haven't been any lodgements to date in Australia. Meanwhile, digital financial reporting is required in the US, Europe and elsewhere. Now, there are benefits to markets and investors from what will enable consistent and more timely financial reporting. We do recognise that there may be some costs, particularly initial implementation costs for companies. Now, our speakers today will share their experiences with digital financial reporting internationally. And we're very fortunate to be joined by, first of all, Mike Willis, the Assistant Director from the US Securities and Exchange Commission, who's going to talk about experiences in the US market. Then Adrian Cloutier, I hope I got that right, Adrian, Global Director, Equity Data at Morningstar, who's going to talk about the use by data aggregators and end users. And from Perth, Anne Tarker, the board member for the International Accounting Standards Board, who's going to talk about adoption of the IFRS taxonomy for digital reporting in international markets. The way we're going to organise things is each of our speakers will follow on from each other without interruption. And then after Anne's presentation, the three speakers are going to be joined by Peter Wells of the University of Technology, Sydney, and James Grant of Westpac for a panel discussion which will be hosted by ASIC's Chief Accountant, Doug Niven. Peter will bring views as a potential user of digital reports, and James will bring to us some of Westpac's experiences with digital financial reporting to the US SEC. We'll have time at the end of the panel discussion for some questions, we hope. We will try and arrange things to be that efficient. You will have seen an outline of our proceedings today and the biographical details of our speakers and panellists in the material we've already sent through to you, so I'm not going to repeat that. Let me hand over to you now, Mike, to talk about the digital financial reporting initiatives at the US SEC. Thanks, Mike.
Thank you, Kathy. I appreciate the opportunity to share a few thoughts today. With that, let me just jump quickly to our disclaimer on the third slide. Of course, these are my comments and not those of the commissioners, the other commissioners, or any of the other staff of the commission. So this is our standard disclaimer. And with that, I'll just go ahead and move into my comments. So the next slide is the outline. And so I'm going to share just an overview of the SEC Structured Disclosure Program, the value realized by the preparers, the investors, the analysts, regulators, and other market participants. Before I get into the details of the SEC Structured Program, let's first talk about why. Why do analysts demand and use the structured disclosure when the data was previously available in the company's reports on their websites or from data aggregators. So the short answer to the question is that time is money, and it pays to understand what the company reported rather than what a third party said they report. So let me give you an example from a U.S. registrant's report. So on the left-hand side of this slide, we have the amount from Amazon's report in Edgar. And on the right-hand side, we have what a data aggregator said Amazon reported. And so there's 17 lines here on the income statement, 10 of which are reflected in what the aggregator provided, which of course means 9 of those rows are not. And that's what has the red boxes. Conversely, on the right-hand side, we see 5 red boxes. We see 2 boxes, but there's 5 disclosure items. These are things that the data aggregator said the company disclosed, but in fact, the company did not. So we go to the next slide. It's not just a U.S. registrant. This is an Australian company, BHP Group. Again, there's 16 lines in the income statement. 6 are reflected in what the data aggregator provides, meaning 10 are not. And there's 7 items that are disclosed by the data aggregator that the company actually did not report. And then next is Westpac, James's company. Here we have 17 lines in the income statement, 5 of which are reflected, meaning that 12 are not. And there's 2 disclosures that are provided by the data aggregator that the company does not report. And so this gives you an example that time is money, but the structured disclosures ensures that the consumer is able to immediately and accurately access and reuse exactly what the company is reporting. And so that's the why. Why is it in benefit of the preparer? This is one of the main reasons. Now, if we go to the next slide in terms of this inline XBRL idea, so this is a combination of HTML, which Kathy mentioned, and the machine-readable XBRL in the background. And so when those two come together, you get the benefits of what's human-readable, while the machine-readable enables some capabilities that were really previously almost unimaginable. And so you get the familiar view for the human and the machine in the background. So going to the next slide is an example of the Edgar open source inline viewer. And this is the Amazon report as an example. And so you can see it looks like the standard report on the right. There's a thin blue ribbon at the top that has a number of buttons. There's a menu of options. There's sections that allow you to immediately navigate to any section you want. There's data that reflects different types of data with a mouse click. Tags to show you different types of tagged items, including the company-specific disclosures, so you can find those with a simple mouse click. And there's other filters to view measurements, segments, dimensions, and other data concepts. All of these tools and capabilities allow you to quickly navigate, but there's actually a lot more here. When you click on a value, you can begin to see pop-ups that will give you the metadata, the definition, and even a link directly to the US GAAP taxonomy. Now, there's some other things we could do with that little box there, and I'll talk about those next. So some of the structured data tools. So as the inline combines both the machine readable and the human readable, it enables sort of what I'll review as an augmented reality idea. We can just go to the next slide. So this augmented reality view enables the SEC staff now to have a bunch of tooling capabilities that were previously unavailable. Let me just run down a couple of them. First is they can aggregate queries for specific disclosures. Let's just say that I want to look at all the R&D expenses in the entire marketplace. That's now a mouse click away. Or all the tax NOLs available for a market or a single segment. Again, a mouse click. Let's say that I'd like to view a trending analysis or a chart of a particular element. I could just click on that number. Up pops a chart, time series chart right on the face of the statement. I can benchmark that against the peers. So maybe I'm looking at United Airlines. I want to compare that against any other airline. That's a benchmarking chart directly on the report, mouse click available. Also, the disclosure checklist. So many preparers have to go through that painful manual disclosure checklist. This automates that, and not only will it help you identify disclosures that are in the report, it can also help you identify very quickly those disclosures that should be in the report but are absent. Additionally, there are filters for the company-specific disclosures, which I mentioned just a second ago. That's useful for identifying flags for potential process and control issues. And It also allows you to share queries amongst team members so that each individual staff person is not going to recreate the wheel. They can share this intellectual property across the team. Redlining any narrative changes from period to period is also another feature that's directly available. So what I'm trying to do is paint a picture of some of the capabilities and tools that are available to not only the preparers, but also the analyst community. Now, further, there's more enhancements that are available with this data that's reusable and accurate. Now, I've broken it up into two areas here. One is for filers. So some of the benefits for the filers include enhanced coverage and therefore capital benefits. This is particularly true for smaller registrants who lack analyst coverage. They can realize lower capital costs and therefore higher liquidity. You also can benefit from processing the more automated information. It allows you to automate some of what was previously been manual assembly and review processes. I mentioned the disclosure checklist earlier, but that would also extend to validation of amounts, updating any changes. All those can be automated and flown through the report. So less manual steps, more automation. Strategic insights by very quickly identifying best practice disclosure examples, our peers, and any type of disclosure benchmarking. As I mentioned, time series charts are available for any numeric value in the report. So those are some of the things that are available for the filers. Investors and consumers, they have immediate access to highly reusable information. Again, time is money. Enhanced coverage, machine-readable disclosures, lowers processing frictions, and enables broader coverage of registrants and disclosures. As an example, labels are also available in a broad range of languages. That enables consumers to view the table elements in a familiar language for them. It may not be English, it might be Korean, Spanish, Japanese, French. It doesn't make any difference. It's useful for the consumer to actually access it in a language familiar to them. It also levels the playing field on information asymmetry. Machine-readable disclosures can be more effectively accessed and analyzed, whereas previous information advantages like those enjoyed by corporate insiders and large institutional investors over non-insiders and smaller investors, those are reduced. Price informativeness, well, the detailed tagging of financial statements improves that, particularly relevant to newer registrants. What that means is if a company's financials are machine readable, its stock price is more likely to reflect the fundamentals of business. Again, as I mentioned earlier, it's as reported, it's more timely, and it's freely available, lowers the cost. It's also ready for artificial intelligence and machine learning analysis. That's because everything is structured, which of course is the first step if you want to apply algorithms. So no need to structure the data, it's already there. You just plug it into the algorithms. So these are some of the value-added ideas of the structured data. Now let's turn very quickly and look at the next slide on the SEC's program. This is a very quick summary. So we started in 2005 with a voluntary program. It was mandated in 2009. In 2017, the IFRS taxonomy was introduced. And in 2019, there was a roll-in of the inline XBRL format that I just showed you. Now, the structured disclosures are also freely available via RSS feeds, via the EDGAR system, which is the SEC's electronic data gathering and retrieval database, and on the SEC website as data sets. Those data sets are updated monthly, and those data sets are among the most popular downloaded assets on the entire SEC website. So for those in the audience that may be thinking no one's using the data, well, the downloads of the data sets say the exact opposite. They're actually heavily used. There's also EDGAR warning messages for filers when they submit their reports based upon what I'll call basic data validation and error types. So if a company's using a data element that's outdated and no longer available, they'll get a warning message on that. Now, something for the preparers that is definitely going to be a question is, what does this cost the preparers? Well, the estimates and cost models vary depending on how the company implements. For example, one vendor makes its software available at a one-time cost of $5,000, while another vendor charges a one-time cost of $2,500 and then has an annual update for $1,300. An AICPA survey, which I think was provided in the pre-reading materials, in 2017, of small registrants found a median cost of $2,500 per year for fully outsourced XBRL services. This represents a 69% decrease from the median cost in 2014. In addition, there was a 2019 NASDAQ survey of 139 listed companies that found a median cost of $7,500 per quarter for XBRL compliance. So that gives you some idea of the range, but I think there's probably a lot more information available on the website. Now, a couple of lessons learned. Again, back to understanding the why. That's available through education and awareness to understand that the prior paper model, electronic paper, just creates misinformation and cost barriers for many consumers, including preparers. Another one is to start with inline. Use the human and machine readable together to enable the new features and capabilities that are directly within the report. Next is company-specific extensions. They're very useful, but they're difficult for machines to consume as they lack context or relationships. Next is the use of tools. When you have machine readability, you need to use tools for both production and consumption. Make the as-reported data as freely and readily as accessible as possible. This is a game changer in terms of what's available for research and analysis, whether it's a market analysis or an academic research. And then finally, data quality errors are correlated with report restatements and reflect on reporting process to control weaknesses. Now, a few things on shareholder engagement and collaboration. This is a key step in terms of engaging the marketplace because in substance, you're exposing some software ideas that you need to get input on. So enhancing the process of controls through automation, filters and validation and quality testing. At the SEC, registrants use the XBRL US, which is a consortium, data quality rules, which are provided on a free access basis. Those rules improve the quality of the reports as well as the delivery speeds. We also have engaged user acceptance testing for any updates we make to the system. That is a collaboration directly between the regulator and the market vendor community. And then finally, there's coordination and collaboration with the standards bodies, the IFRS taxonomy, and related implementation guidance. It's available through their intellectual property. So some topics for future consideration. This is certainly not a complete list, but some things that are on my mind. First would be improving and expanding the scope of the data quality rules. That's an ongoing market effort, and the XBRL US Consortium updates those rules pretty frequently, almost on a quarterly basis. Additionally, the anchoring of the company-specific disclosures, that refers to creating a relationship or a connection between a company-specific extension and other parts of the taxonomy that give it some degree of context. Block text tagging of the narrative disclosures should be applied beyond just the financial statements. It's applicable to many other sections of the annual report. Third-party assurance on the inline reports may also help to improve data quality while lowering the related cost through the improved process automation and quality assessments that I mentioned earlier. So auditors may benefit from this as well. Structuring may also extend well beyond the financial statement disclosures to include corporate actions, holdings for funds, structured finance products, and many other areas. Enhanced data analytics, applications and functionality, you can imagine with all this additional data, there's a lot more analytics that you could run to gain insights. A technical matter is to leverage the open information model to tailor the technical format of XBRL data to the needs of the users. It might be in XML today, it could be in JSON or CSV tomorrow. Now, there's other improvements that I'm sure that you'll come across as experience is gained, but here's a couple that I think would be useful to you. So just to close up, that's about as much as I can put into a 10-minute session. But in short, the punchline, supply chain standardization works to lower processing costs while improving quality and throughput, just like the barcode in the grocery store. This email address is where you can reach me if you have questions after today, and I'm happy to do it. Thanks again for the opportunity, and I'll turn it over.
Thanks, Mike. So I'm going to be going through speaking to the benefits that data aggregators see from digital reporting. So next slide. So a little bit of background on who Morningstar is. We're a global provider of equity data, and so we've been collecting equity data in about 136 countries around the world. We've got a team of around 1,000 analysts currently collecting this data, and we have over 20 years of experience in the business. And our core principles, like many of our competitors as well, for our equity database is making sure we have accuracy, standardization, and speed of delivery. That's what's really important to us and our clients. And also, just to show you a little bit more background about Morningstar, it's not just about the primary financial statements themselves, it's about all the data that comes along with it that we also collect. So collecting information such as corporate events, mutual fund holdings, the whole gamut to really provide that full picture to clients, and having a global reach there you can see by market cap. So how do we use XBRL today? Currently, we're using XBRL for 3 markets, with another 3 in active development and another 36 being researched. And how we do it is we take what we have in our systems is called the global taxonomy. So Mike actually was showing a bit about that. All data aggregators usually have their own taxonomy where they try to bring all companies together to make it an apples to apples comparison. So what we've been doing today currently is collecting that data out of the financial reports. So having an analyst go in, manually scrape that data and put it into our systems, and then out into our global taxonomy, which you actually see a little snippet of there on the right. For XBRL, it actually makes things a lot easier. We can map all the XBRL automatically to our taxonomy. So especially when the market is using a taxonomy like IFRS's taxonomy, you can just map that straight. And then from there, that global template data, that's how we generate all the metrics and data that you see within our systems today. And so just there, you can see 2 groups, 2 companies, Bank of America, Citigroup, both may report differently or use different terminology in the reports, but they mean the same thing underneath from their line items. So it's XBRL allows us to map all that to make sure that everything's on the same basis. Next slide. So how does XBRL help Morningstar, which then in turn helps investors? So the keys here, accuracy is the biggest one. No fat finger mistakes is great for us. And obviously when you're collecting, like I said, 136 countries around the world, over 50,000 companies, there's always an opportunity if you're doing that manually to make mistakes. So having the machine do it all for you, perfect. The metadata is always available. So being able to see right in every single tag, what are the units, what are the time period, there's no guessing. I can't tell you the amount of times that we've actually spent just trying to figure out in a company report interpreting a paragraph or a sentence. Are you referring to the pre or before? Is that the full year amount? Is that the quarterly amount? And that's not needed here. You've got all that information out there. And as Mike was saying, inline XBRL is great for allowing that traceability. So being able to show how aggregators got to the final values they did, or showing up on a website or to a client, you can click back and see exactly where it came from. Standardization is huge. So consistent use of XBRL tag really allows both historical comparisons within the company. So as long as a company is using the same tags over time, you can easily track and see growth and track accounts, but also allows when you're using a global taxonomy, a taxonomy like IFRS or GAAP, you can therefore see between companies. So it makes it easy if everyone's using the standardized tag. Whereas right now, it's the generally accepted accounting principles. Everyone's got slightly different wording, slightly different interpretations. It's great when you can all bring it together. Speed is a huge one too. Collection of the data can basically be instantaneous. Right now, it takes hours to days for all data vendors to collect data. Unfortunately, there are peaks to everyone's reporting seasons. Therefore, there's only a limited amount of capacity that you can have to be able to staff to be able to collect all that information. When you have it all being done digitally reporting, that speed is no longer a factor, and actually brings everybody on this kind of a same playing field as well. So why does this help investors? So this is what's good for Morningstar, but what we feel was good for Morningstar is also, in the end, we're serving the investors. Those are our clients. A lot of retail institutions and institutional money managers, they rely on data vendors such as Morningstar or an S&P or a FactSet to provide the data. So the quicker that, the more accurate, more standardized, more speedy we get the data, that in turn leads the same for clients. Next slide. So what do we see as the keys to a successful consumption of XBRL? Completeness is number one. I would have to say for sure. Seeing the markets that we've taken on in the past, making sure that all the information that you provided in your standard reports is also available in XBRL is very, very important. Otherwise, you're going to have to switch between the documents, and that just doesn't really help from a speed point of view, and also can lead to inconsistencies. If you see different values or things don't sum up that in XBRL, but you saw it in the PDF document, that creates confusion. And this also applies to what would be traditionally called like non-IFRS or non-GAAP information. So talking about, say, a normalized earnings figure or an EBITDA figure that management puts out about their company. It's great to have as much of that information as well into XBRL. Accuracy, it may go kind of without saying, but making sure you put the same effort into the XBRL that you do into your traditional statements, that's very important. Again, like I said, sometimes you've noticed, especially at the early adoption of markets, seeing differences between the reports, and then you're left with a guessing game of which one's right. You do not want that to happen, to have those inconsistencies. And then consistency from a tagging perspective. So one, ideally you use the taxonomy like IFRS to make sure that you're not just creating your own new tags, making sure that you're using the correct tags. So going through and making sure it's the best choices that you've made available to represent your financial statements. Consistent use of that tags between periods is very important, so it doesn't jump from one account to the other. And Mike had talked about it as much, is obviously companies are going to need sometimes to use their own company-specific extensions. There's always going to be events that just cannot fit nicely into the taxonomy, but trying to minimize that as much as possible. The taxonomies are really comprehensive, and they're reviewed constantly to make sure that they've got the tags you need. Chances are there's something in there that you can use. Every time you go outside of that, it does make it a lot harder for the machines and the data aggregators, and quite frankly, anybody who's pulling the data to do that in a consistent method. So doing that. And then lastly, another shout out to iXBRL. The more we can make things both human readable and computer readable, the better. It's the best of both worlds. And you can see that now with a lot of the data aggregators being able to populate right on their websites or through their products. You can actually click through and see exactly where those documents came from. That's something that's really happened in the last couple of years, and that's because of digital reporting. You can be able to do that. So you can not only see how aggregators took your data and then rolled it through, so you can go all the way through, say, look at something like a return on invested capital, click all the way through it, a data aggregators methodology, but then you'll get right back to the primary statements that the filers put in there. So I think that's creates that beautiful audit trail that no guessing game. Everybody fully understands what's going on. So that's it from me.
Thanks, Adrian. I'm very pleased to be part of this panel this morning. So I'm Ann Tarker, and I'm going to talk to you a little bit about the IASB's experience with taxonomy. So next slide, please. So I wanted to touch on three things. What I see as the key challenges for what I'm calling modern financial reporting. Secondly, some lessons from international experience. And thirdly, my comments on opportunities for Australia. Next slide, please. So in terms of key challenges, we're talking about maximising the benefit of technology. And I think Mike and Adrian have already set the scene very well, explaining to us many benefits that perhaps we were not aware of. Digital engagement is widespread in our lives, and there are opportunities now, in Australia in particular, to do much more in the financial reporting area. So presently we have a hybrid situation with reports in PDF that reflect a very traditional paper-based approach, and on the other hand, data widely available in digital format via the data aggregators. There are indeed many benefits of digital financial reporting, and again, Mike and Adrian have outlined those type of benefits for us in their comments today. And the thing that really strikes me is this idea of more data available for more people. Sometimes at the IASB we talk about the democratization of data, wider access to data for more people and more coverage of companies, and access to the as-reported data. And Mike's given us some excellent examples of what we're talking about here with as-reported data. The present opportunities internationally remind me of the situation prior to the widespread adoption of IFRS standards. Back in the day when we had different accounting standards, which were barriers to comparable analysis by investors. Now we've come a long way since then with IFRS standards, but to continue to benefit from global standards, we need widespread international use of common taxonomies. The IASB has supported digital financial reporting for many years via the development of the IFRS taxonomy that accompanies the IFRS standards. The IASB's role is to ensure that the standards and the taxonomy are aligned and fit for purpose. Our recent research has found demand for accessible, timely, accurate, relevant and structured financial information. And this demand exists from a range of stakeholders, including investors, regulators, and technology agents. There is also demand for preparers, but at the moment they are less keen because they have a cost focus. However, there are preparers that are seeing the benefits and seeing tagging as part of an accounting system and part of the internal use of data. The IASB does not mandate the use of the taxonomy, so further progress in digital financial reporting will require a combined effort of all parties: companies, investors, auditors, regulators, and the standard setters. Next slide, please. Looking now at some lessons we've learned from observing international experience. So our international leaders at the moment are the US SEC, and they're a leader in this area. We've heard about that today. Now, the ESMA, which is the European Securities Market Authority, has made a huge commitment via its electronic platform called ESEF, and this is the platform that is requiring digital tagged financial reporting for the listed companies of Europe. And that initiative is all about developing and supporting the EU capital market. So companies are providing tagged financial statements from 2021 or 2022, tagged financial statements with block tagging, so tagged on the primary financial statements and then block tagging into the notes. So some companies and regulators are already engaged and filings have occurred for 2021. An important feature of the ESMA initiative is the requirement for the audit of the tagged financial statements. So that is happening, and it's a work in progress. There's also a work on a central repository, which the ESMA is calling ESAP, ESAP, and that would allow the central repository allows the access to the data, which we've already heard about as being so important. And the EU is committed to that essential part of the infrastructure. So the ESMA work and the ESMA approach really reflects on the learning from the SEC, where they have now a very deep experience. So as ESMA's approached this, they've learned from the SEC experience. So, for example, recognising the demand for detailed tagging of not just primary financial statements, but notes and other reporting as well. There's a demand for the financial statements and the digital financial reporting to have the same content, and that's linked to the audit requirements. Thirdly, the data needs to be accessible. And the US experience, I think, shows us that for digital financial reporting to be successful, and by that I mean there is widespread use of the tagged data, that data quality issues are extremely important. Again, we've heard from Mike about various initiatives that are taking place with the SEC and with XBRL itself to promote data quality, which is of great importance. Next slide, please. No, indeed. May I go back a slide, please? I just want to talk about something that's been happening in other countries. So in our investigations, we've observed that many countries do have taxonomies in use. Some of those have been developed nationally and they're serving national regulatory purposes. So they're providing company data to the regulator or the tax office. So some of these national taxonomies serve a different purpose to the IFRS taxonomy, and they don't align with it. So thinking about taxonomies for financial reporting, Brazil and Japan, for example, have proprietary taxonomies. In contrast to this, in the EU, in South Africa and South Korea, the IFRS taxonomy is used, and that additional elements can be added for the purpose of the regulators, so in addition to what's in the IFRS taxonomy. So as countries look to develop digital financial reporting for investors in capital markets, the IFRS taxonomy needs to be adopted in order to get the benefit for the international investors and for international capital flows. It aligns with the idea of IFRS standards being used in jurisdictions around the world. Making use of a range of country-specific national taxonomies doesn't support the objectives of global adoption of IFRS standards. So we consider the recent example of the UK, although they do have a proprietary taxonomy for national data collection, they've now decided to use the IFRS taxonomy for the listed companies, for the financial reporting benefits, for the benefits for the capital market. We've heard from Adrian about investors' needs for comparable data sets and all companies and in the time series. So this, of course, means that the data needs to be accessible through a central repository. Brazil, Japan and Korea are countries that have accessible filing repositories. South Africa has a repository but charges a fee for access. So that gives us a tiny snapshot of what's happening globally, but I think it communicates to us that there's an enormous amount happening. It isn't just something that's occurring in the US or at Europe. Next slide, please. So to conclude my comments, I'd like to talk about opportunities for Australia. I think it's a matter of an imperative now for Australia to stay globally connected. Australia was a leader in the adoption of IFRS standards, and Australia just needs to join in with the momentum that's happening and build on this to be part of digital financial reporting. And the clear message, I think, that comes out of this panel that the digital financial reporting is the thing that is going to support the development and the operations of the Australian capital market. And that was behind the idea of adopting IFRS standards in Australia. Australia was seen as an early adopter. Parties joined in together and made it happen. I think the same thing can happen with digital reporting. Australia can make use of the IFRS taxonomy. We've already heard from Kathy that it is available already. ASIC has got it in place, and the regulatory add-ons that ASIC needs are in there as well. Our research shows us that investors need an infrastructure to support digital financial reporting. That includes the tools. So for software vendors then, there are commercial opportunities. We're hearing and we can see that an accessible, centralised online data warehouse facility is needed, and that is something that can be developed. Australia has a lot of existing systems and processes already in place that can be leveraged. Australia has great wealth in many dimensions. Talent is one of those great wealths. And so many of the advantages that Australia has can be leveraged through innovation and technological development to really get up to speed in digital financial reporting. What we have observed is that leadership in digital financial reporting and the use of the taxonomy does come from public policy. It comes from various government initiatives that come through regulators. And I believe with leadership and support from all the various parties in the Australian financial reporting community, Australia will be very well placed to benefit from digital financial reporting. These are the recommendations that came from the Joint Parliamentary Committee at the end of 2020, when they saw a clear case for Australia to be making use of digital financial reporting. And I think that our panellists today have been able to present a very strong case to support digital financial reporting in Australia. And I'll close my comments there. Thank you.
Well, I'm Doug Niven. Firstly, I'd like to thank Mike, Adrian and Anne for their insights. And this brings us to our panel discussion today. As Kathy mentioned, our three speakers are now joined by Peter Wells of UTS and also James Grant of Westpac. And I'll perhaps ask all of our panellists to unmute themselves and turn their videos on, which I think has happened. So I'll kick off the panel discussion with some questions for each of the panellists, and we'll also aim to leave time available for your questions. I notice a couple of questions have already come through, so that's great. And please continue to submit your questions through the Q&A function. We'll try to cover as many as we can, and those we can't, we may be able to answer after the session and send back the answers to everyone. So without any delay, I thought it would be good to start off with Professor Peter Wells and some questions for Peter with his hat on as academic and to some extent a user of financial reports as well. So firstly, Peter, given the increased adoption of digital financial reporting around the world that we've heard about, why do you think we aren't adopting it here?
I think that when you hear about digital financial reporting around the world, it's made enormous headways. In Australia, it hasn't. And I think the reason why most people say that it hasn't advanced in Australia is they're concerned about cost. Now, I think from what we've heard Mike say already, the cost of preparation for smaller firms has come down significantly. And for larger firms, if you think about most of our larger firms, they're US SEC registrants, so they're already preparing XBRL reports for lodgement in the US. So therefore, the cost of presenting such information in Australia would be virtually zero. So that's been one of the major impediments. And I think one of the things we've failed to acknowledge is the fact that digital financial reporting brings enormous advantages to users of financial reports. It increases accessibility to information about corporations. And in periods before and after we saw digital financial reporting in the US, we saw some documents being accessed 300,000 times in a period before digital reporting and 8 million after. Accessibility was a key issue. We also see that it's much more likely to be accessed by smaller investors, and this is going to benefit not just smaller investors, but also smaller firms. So there's going to be an enormous increase in accessibility of data, and there's a body of research which shows this. There's also going to be an improvement in data accuracy, and if I could pick on one thing which I've always noticed is that if you look at impairments in Australia, it's always a question mark over whether it's going to be disclosed as an impairment in a database or whether it's going to be aggregated with abnormals. So digital financial reporting for users is going to increase accessibility and accuracy. It's going to lower for users information processing costs. There's evidence from overseas that XBRL has improved analyst forecast accuracy, and there's been a reduced information asymmetry for firms early adopting. All of this says that there's going to be a lower cost of capital for firms. So that's why it's somewhat perplexing that given the costs aren't that significant and the potential savings in terms of a cost of capital, why it actually hasn't occurred. In terms of what Mike and Anne have both alluded to in terms of machine learning, the papers are starting to emerge now that with machine readable data and AI, what we're starting to see is that this can be used to develop strategies for trading, and these are generating returns, depending on which paper you look at, of between 6 and 12% abnormal returns per annum. So there's enormous benefits there for users in terms of having machine readable XBRL data, and there are benefits for corporations to the extent that it will flow through to a lower cost of capital. The other benefit which I see coming through is for regulators like ASIC, and it'll allow them to much more effectively review the quality of financial reporting. And what's interesting is that the Danish Business Authority, they regularly review with machine readable and artificial intelligence 230,000 annual reports annually. Doug hasn't got a chance of doing that with our paper-based system. And that's going to result in higher quality financial reporting, and that's going to be a benefit to users and also to the regulator. What's also interesting is that in the US, there's evidence that with digital financial reporting, there's been an improvement in financial reporting quality more generally, and this is attributed to the use of machine reading and AI by auditors to identify what might be problematic disclosures in financial report. And if I could use an example of one which appealed to my sense of humour, it was where a firm was using in its disclosure its determination of a terminal value for impairment testing, and they had a terminal value growth rate which was significantly higher than the sales growth rate. Unless you believe in continually declining costs, then that's simply not possible. And a machine learning process would very quickly identify that. So there's going to be a lot of benefits for users, regulators and auditors, and I think these well and truly overweight the costs. So it is quite perplexing that we haven't seen any development in this space in Australia. Thanks, Doug.
Thanks, Peter. And I might come back to you with another question a little later on. I'd like to pose a question to James Grant of Westpac. And of course, James, Westpac is one of the foreign issuers who has actually been preparing a digital financial report for lodgement with the US SEC. And so I'm interested in your views about use of digital financial reporting in Australia and particularly the present situation. It appears that some finance executives might view digital financial reporting as just an extra compliance step, sort of ticking a box for the US SEC or perhaps even Europe, and not really seeing the benefits. So what's your perspective on that?
Yep. So it is a very topical discussion, and as Mike has mentioned, the views I represent here are my own. So on one hand, you do have there is incremental cost. So there's an additional step at a peak time in a very busy condensed reporting period where companies are trying to file their reports. It's quite clear that this would introduce an additional step into that process. You have the cost of implementation to consider, whether you go for a software solution where you do it yourself or you outsource the tagging to a third party, both of which come with that change risk. And on top of that, we also have the considerations around is this information to be audited, and does this fit within the auditor's opinion? So there's still a lot of consideration and costs and operational factors to consider. I'd also mention that there's also been no uptake to the voluntary regime in Australia, and reflecting on why that is, I think it's because there's no perceived benefit to individual companies moving to XBRL. This is clearly, and from all the analysis that we've heard to date, this is a capital markets benefit, and we see the larger capital markets moving towards this to give more accessibility to investors, creating a deeper capital market. So it's clear that everyone has to move together at the same time, and for everyone in that market to participate and get that benefit from filing.
Thanks, James. And I guess people refer to that as a chicken and egg situation. Companies aren't seeing the benefit because no one's set up to consume the information in Australia. And on the other side, analysts and others aren't set up to consume the information because no one's producing it. So it's an interesting dilemma. Do you see that digital financial reporting could bring benefits to preparers? Can indirectly companies benefit from the use of data by investors?
Yeah, so I mean, conceptually, increasing the amount of information in the market and that accessibility is generally considered a good thing by everyone. So that capital market benefit, as I said, every company would participate in that, and accessibility is a good thing. I think the analogy I use is if the whole tide is rising from the depths of the capital market perspective, then every company floating in that market benefits. Thanks,
James. And I might go to Peter for a second question. It sort of flows from your discussion earlier. So what role do you actually see for government companies, regulators, dare I say, and others in moving to digital financial reporting? And Peter's on mute, I think.
Sorry about that. I think we need to mandate it. I think that the voluntary process hasn't worked. I'm surprised that it hasn't worked as much as at all, rather. And I think that we need to see a central role for ASIC to provide a repository so that there can be access free and easy to the data which has been provided. I think that's what we've learned from Edgar, that it needs to be easily accessible, and I think that's critical for it to work. I think that we have a taxonomy. Maybe the AASB needs to endorse it. I'm not quite sure what the requirement there is, but that would be quite easily done because the AASB typically just follows the IASB in terms of most accounting standards. If there was going to be a transition process, maybe it would be like the US and apply it to listed companies before we applied it more generally. but I think that there's a driving role here for ASIC to actually provide the repository and to provide the regulatory impetus for it to occur, although that probably comes from the government, not from a policy decision by ASIC.
Yeah, and on that last point, there has actually been a question about would ASIC provide the repository? And the answer is at the moment, well, the individual digital financial reports are available, but we don't have a data warehouse. And whether that will be provided in the future by ASIC or by the market, data aggregators and so forth is something that will need to be thought through. But I might turn to Mike now for a couple of questions. Actually, the question I was going to ask you first overlaps with one from our audience as well about how earlier implementation issues were dealt with in the US. So one of the issues we've, of course, heard about, you touched on this, is tagging inaccuracy, affecting the quality of the data and its usability, including the use of company-generated tags or extensions. So how do you see that they affected digital financial reporting, and how did you address the data quality or accuracy issues?
Doug, well, just to make a point that these are two different things. Tagging inaccuracy is different than company-specific extensions. But that said, tagging inaccuracy is a data quality problem, and it offers the consumers and the analysts a signal on reporting process and control weaknesses. And so the comments made earlier by Adrian to pay attention to the XBRL, just like you do, that's a very important comment, a very important idea. Now, the SEC staff have worked to address a range of these data quality issues through coordination and collaboration with the XBRL US Data Quality Committee that's generating those data quality rules. The SEC staff also issues data quality reminders on a range of topics that we see occurring in the market and the reports. We've also incorporated the data quality validation rules into the taxonomy directly, and we've begun to include some of the basic rules in the EDGAR submission process. So that gives the registrants a warning when they have these types of errors in their report. Changing now to the company-specific extensions, I think that those are very helpful when used in an appropriate manner. And what I mean by that is when there's no tag available, then it gives the information on that unique aspect of a company's business model prominent attention and a way to express that. And that may be for a company's business segments or something else that's unique to the company. Conversely, company-specific extensions can be harmful when used in an inappropriate manner. So if you were to use it for something that already exists, like, say, revenues, that's not appropriate. But yet we see that all the time. So the SEC's open source inline viewer, as I mentioned earlier, that enables the identification of company-specific extensions right away with a mouse click. You can see them all. And I think that will help, that is helping both preparers and the investors identify these types of disclosures very quickly, and therefore to understand what's unique about the company versus what's in those standard buckets.
That's very helpful. We've got a number of finance executives in our audience today, and I'm sure they're thinking about the comments that have been made already about benefits and costs as well. What was the US experience from the point of view of preparers?
Yeah, so Doug, this is a great question, and it really depends on how the preparer implements. Everybody wants to know about costs, so some things I would point people to are in the pre-reading materials. The independent AICPA survey that noted that digital reporting costs have continued to decrease. They also mentioned that the quantifiable independent information on costs based upon company size, reporting complexity, and the range of reporting services that are provided. So there's a lot of variables in those cost estimates. So I would say take a look at those pre-reading materials. Now, what we can see is there's an observable learning curve from the advent of the structured disclosure requirements in 2009 to 2011 to today. And you can see that both the continued decrease in company-specific extensions, where the taxonomy has gotten better and the process has gotten better, the tools have gotten better, and also the data quality errors and the enhanced timeliness of the filing. So there's three factors that are showing this learning curve. The data quality has significantly improved, and the preparation software has evolved greatly in the years since we kicked this thing off. And that's really part to do with the XBRL US data quality rules. I really can't emphasize that enough. The inline XBRL filing also facilitates the preparation of the reports by enabling those more automated process steps, whether it's benchmarking, the disclosure checklist, or even risk assessments. Those now can be much more automated by the preparer community. I think James touched on this earlier, is that preparers themselves have benefited from some of the XBRL requirements. We've seen numerous peer review research showing that companies which file an XBRL actually enjoy the reduced cost of capital, and they're better able to avoid some of the investment inefficiencies. So those are just some examples that I would point to in terms of the preparer, but I'm sure there's others, both on the cost and the benefits that I've left out, Doug, so I'll just stop there.
Okay, thanks, Mike. Probably good to stop, otherwise we could let you talk all day on this. I might turn to a couple of questions for Adrian, in fact. I guess people probably think of benefits in some respects to analysts and institutional investors. What do you see as the benefits for, I guess, the larger consumers of information, as well as small investors and really the whole range of users of financial reports?
Honestly, both. Everybody really benefits from digital reporting, and the key reasons for this are some of the things I hit on in my presentation. Accuracy, standardization, and speed. Everybody wants that. That goes to the smallest investor or to the largest. So people, so some of our clients, such as Morningstar, are online brokerages. Actually, power a lot of them in Australia. And so the quicker and the more accurate we can get the data, then that allows maybe a smaller investor who's looking through their brokerage, looking at maybe a PE multiple or anything. They want to make sure that's up to date. They'll get that quickly. And then you go to the other end of the spectrum. You've got somebody like, say, I don't know, a portfolio manager. They want to be able to pull large swaths of data and do their analytics. Some of the stuff like Mike was saying, like showing those cool new ways to do the data. They can pull all that data together. And one of the points that I think Anne mentioned that we really like is that democratization of data. As much as I think it's a huge benefit. As much of it actually kind of traditionally erodes something like a Morningstar's traditional line of business, where you actually needed 1,000 analysts to go and collect data if you want to do a large, across countries or across even within industries. You want to pull all that data. You need to have a lot of data on us to even just get the data. Now you don't. You honestly don't need us to go and do that work for you. You can get that data free of charge. It's nicely standardized, and that actually allows then us to focus on, and we don't mind that. We have the best, what's best for the investor, we think is best for us as well, because that allows us to pivot and be more on the analytics and research side of the house and provide more insights to investors. So I think just across the board, this is great for everybody.
How do you see the future take-up of digital financial reporting around the world? Obviously, it's growing, but and I guess a supplementary question to that, as it's taken up, how would that actually change the way that Morningstar processes data?
Yeah. So I think we've touched on it a lot of the presentations, but we really see it gaining traction. Obviously the U.S. led the way, but then we're seeing it now as was discussed in Europe with ESMA, India, obviously Japan, Taiwan. They're all around the world. It's more and more becoming a part of the way data is being provided, which is great. I think that the more markets that adopt it and the more that follow taxonomies, the greater and more efficient that the data will be for both us and for anyone else who wants to build that, whether that be another data aggregator or investors straight themselves. And that just in turn leads to better products and better advice for end investors and better results. I think it also levels the playing field. So we talk about how our data is done, and it was discussed before about peaks and troughs. Most data providers all have to run some sort of priority system. That naturally, just the way the markets work, everyone's filing around the same time, and you only have so much time with your team. You only have so much time to process those reports. So inevitably, usually the smaller market cap companies move to the back of the line, and then they get done within days, or even in certain cases up to weeks later. This really levels the playing field for everybody. We're able to get get the data out from the smallest company who files to somebody as large as Apple. It doesn't matter. It comes in, it goes through our systems. You've got that data right out there. And so there's no, in today's day and age, information and speed is key, right? You don't want to find out about a report, 3 days later, and some smaller, somebody who has the ability to maybe put their analyst team to it is acting on information that you as a smaller investor or somebody wasn't able to glean because you weren't fast enough. You didn't have the time to process it. Now that brings that all on a level playing field. You're not on the wrong side of a trade because somebody knows something about a company that you don't, because everybody got that data quick and accurately. So I really think it's going to change the way, bring everybody more to that level playing field.
So that's really helpful. I mean, people often think, well, digital financial reporting will put you out of business. I guess that's not the case. You'll have better information.
We'll have to evolve, right? And I think that's fine. Like I said, that is, and we investors first always. So we'll just find new ways to do analytics on top, which is what we should be doing. We don't want to be the middleman between the company and the investor. We should be the ones helping advise investors with the same information together. This is what we look at through analytics and that lens, provider value there.
No, thanks for that. And I'll just turn to Anne for a couple of questions. So you probably touched on this already, but what do you see as the benefits from digital financial reporting for capital markets?
We've heard a lot about benefits from our various speakers. The benefit that I see happening is that this accompanies the IFRS standards. There are many benefits that have come from the IFRS standards, from the global adoption around the world. We have a situation where US GAAP and IFRS standards have a lot in common. They come off a very common base, and the standards are not exactly the same. And there are areas of difference, but there's also areas of commonality. So we're looking at two major initiatives, and the IFRS standards now used in so many countries. They've been embraced in more than 140 countries around the world. So the taxonomy goes hand in hand with the standards. And if we're using these standards internationally to have one common language, then it makes sense to have digital with one common language. So I see the benefit coming from digital being that we can then build on what we've got with IFRS standards. If we don't go digital everywhere using a taxonomy that has IFRS taxonomy as the base, we're then going to lose the benefit that we got. And we did globally get a huge benefit in terms of adopting IFRS standards. And we need to back that up with taxonomy. So that's where I see the benefits, Doug.
So why do you think we in Australia, under the voluntary regime, have been slow to embrace digital financial reporting?
James has touched on this. Even for a large institution like Westpac, where the tagging is already done, there's not benefits, as I understand James's comments, there's not benefits to be an individual. It needs to be everybody. And that's come up through Mike and Adrian's comments as well. And this is certainly what we've heard from investors. You need a large data set to work with this. So it needs to be, it doesn't help to have one person. We need everybody, everyone in. And so, again, everyone in on the IFRS taxonomy, not everyone in with national taxonomies. That's not going to work. So it needs to be everyone in. So in Australia, governments are always conscious of regulatory burden and the dead weight of regulation. It's been a political theme in Australia for decades. But I think the cost-benefit equation is now changing. And we've heard today very encouraging comments about the software support that's available, the data quality, how that's being addressed using machine techniques, all sorts of techniques to address data quality. We've heard about ways that the issues that were there have been addressed. So I think the cost-benefit equation is changing, and I think the time's right for Australia. So where countries do adopt digital reporting, there is a lead. It is government decision, as many policy issues are. Many things in the regulation of financial markets come out of specific policy initiatives driven by one thing or the other. So what we see in the EU at the moment is driven by the development of the EU capital market. That drove the adoption of IFRS in the EU, and it's driving the embrace of digital and all the efforts that are being put into digital. So we need some leadership in Australia that comes from the government, from actually making policy decisions, and there's various parts of government that assist with that, be that Treasury, and indeed ASIC becomes part of that equation. But I think cost benefits have changed, and I think it's time for Australia to get involved.
Okay, thanks, Anne. So I think we're hearing a couple of hints there about the possibility of mandating. I might actually turn to James on the question of mandating. Clearly you're not seeing things working in a voluntary regime. Do you have any personal views about whether digital financial reporting should be mandated?
Taking myself off mute there, Doug. So it comes back to that overall capital market view. So empirically, we see that in a deep capital markets, then there's benefit to cost of capital and accessibility to information on a timely basis. On the other hand, there is a cost of implementation, and it's balancing those two things together. As Anne said, the momentum is moving through the larger capital markets throughout the world, and that's moving towards Australia. So, is it a question of when, not if?
Okay, thanks, James. Well, we are seeing questions coming in from our audience, and please continue to submit questions. We've still got plenty of time left for your questions, by the way. And one of the questions that has been raised, and I might direct this in the first instance to Mike, is around the role of auditors and the value potentially in auditors giving some sort of assurance around the accuracy of the tagging and how you've viewed that in the US. I think you already touched on it in your presentation.
I did. I think I answered the question in the chat there. So in the European effort, audit is required on those ESMA reports, and so we'll see that going forward. In the U.S., there are no requirements for assurance on the inline reports. That said, I'm a retired audit partner from a big firm, so I was actually involved in auditing some of the initial voluntary program reports, both for United Technologies Corporation and for Grace. And so that process, as I mentioned in my comments, the standardization of the data, it's not just at the financial data. You can go back and standardize other lower levels of data. And when you do that, you enable significant automation of what would be standard audit procedures and audit processes. And so in the standardization of a supply chain, the information flows and the reduction of friction really does begin to benefit lots of other people. Now, while I think this question was asked in the context of third-party assurance, I'd also like you to think about internal audit, because they would also benefit from the same idea, but simply within the companies. Now, there is a large U.S. company that actually did that, a company called Hewlett-Packard, and they wrote an article about it in the Journal of Accountancy called Driving Faster Decisions. And so I'd encourage any of those interested to go look at that article, Driving Faster Decisions, which really lays out the business case for standardizing internal systems using a standardized model that would also flow straight into the financial statements. So in my humble opinion, I think there's a very solid idea here in terms of enhancing data quality while also being able to automate many of these audit procedures that are currently somewhat manual and dealing sort of around the edges with the company's data.
Thanks, Mike. I don't know if any of our other panelists want to add to that. Doesn't look like it, so we might move on. We did receive a couple of other questions which are interesting, and I'll see if any of our panelists wants to tackle these questions. Otherwise, I suspect they might be directed to me. So one is, firstly, which government agencies would have access to digital financial reporting in Australia? So I'll see if anyone wants to volunteer an answer, or I might end up answering it myself. Okay, that looks like
So,
Mike and
Doug,
James.
I will tell you, in the U.S., many other agencies use the data that we make available. The IRS, Treasury, currency, even there's 5 or 6 of the major agencies that use the data. So it's not just the SEC that's using the data.
Okay, looks like I may not need your answers. We'll think James and then Peter.
I was just going to say, I think you've self-nominated yourself for that one.
Okay, all right. And Peter, do you want anything to add anything before I...
If I could just push it in a slightly different direction, there are a number of non-corporate entities that prepare financial reports, and the issue of how they report and how their reports are available or not available is an issue. And for example, I might refer here to superannuation funds who lodge a report with APRA. However, that's not publicly available. I'm sure if there was a platform provided by ASIC and that the superannuation funds provided their reports to that, then there'd be enormous benefits to people who would be able to look or see the financial reports for the industry super funds, and for them to be able to use the same sort of tools to analyse the information contained in those reports. Can I say that a challenge also in using the APRA data, and this goes back to one of Mike's comments about firm-specific tags, they must articulate into the financial statements. A challenge in using the superannuation fund data is that it doesn't articulate into the general purpose financial reports prepared by the industry super funds. And for me, that's a major impediment to their usage. So two points there. One is that I think we can extend it beyond corporate entities, which are economically significant. And 2, a second comment would be that when you have firm-specific tags, unless they articulate, then they're going to be isolated disclosures and probably not very relevant.
Okay, well, it looks like it's now over to me to answer an expanded question. At the moment, of course, anything that's lodged on a public record with ASIC, including financial reports, is accessible by anyone, although fees may be payable for doing that. So in digital financial reporting information, even without any change in the settings, would be, if anyone voluntarily lodged a digital financial report, that could be accessed by anyone, including other government agencies. I suspect part of the question may have arisen because of this idea of lodge once, use many. That's not exactly how it works with financial reporting. We actually have a separate set of tags, a taxonomy for financial reporting, which is IFRS taxonomy, and another big taxonomy for everything else. And the logical reason for that is we want to be consistent with the one language that Anne was talking about. Other agencies do already want to access information, and we regularly talk to them about accessing that information, and they'd like not to have to pay the fees that everyone else does, but that's a separate question. I guess going to Peter's point, just to add quickly on the public offer superannuation funds, the APRA regulated funds, they aren't actually regulated from a financial reporting and audit point of view at the moment. Legislation is likely to be introduced into Parliament later this year, which would give ASIC the regulation of those financial reports so that they would be treated in the same way largely as other entities under Chapter 2M of the Corporations Act. APRA does obtain financial reports on request. They're not actually required to be lodged. Audit reports that would change under this legislation. So it's a little bit watch this space, but we're probably talking June 2023 year ends for that one. So another question, and I might in a sense start with Mike on this one because it is a question from the regulator. So looks like you and I are getting all the questions at the moment. Maybe they're coming from another regulator. So do you expect significant benefits is a question from your own risk analysis? I guess in surveillance of financial reports, which of course we do not for ourselves, but for the market more generally, as a result of use of standardised tagging. So I might start with Mike in terms of use by the SEC in their surveillance programs.
Yeah, the short answer is yes. we've already realized those. And an example would be the application of artificial intelligence and machine learning to the reports themselves. And so assessing, say, the tonality changes of narrative disclosures compared with the relative changes in the numeric results. And so you would expect those changes to be pretty much aligned. And where they are not aligned, that's an indicator that maybe we need to go in and take a closer look. So that's something that might not be completely obvious, but something that we're currently doing. And the structured disclosures enables us to do that by leveraging the machines to look at this stuff for us and to kind of help us identify scenarios that may potentially be a higher risk example.
That makes sense. And I guess one of the things, as I say, we consume financial reports for the benefit of the market. We're not actually investing, so we're looking at them a different way, which is, are there indications of problems in the financial report? And so that involves a different analysis. We certainly target financial reports on a risk basis. And so, the better data you can get, the better analysis you can do, and more timely. It goes back to many of the things that Adrian was talking about before, about timeliness, consistent classification of data and so forth, and perhaps more granular in some cases as well. So, thanks for that question. And just having a look at what else is coming through at the moment.
Doug, another example of that might be the granularity point that you just made. With the COVID scenario, we had some tax law changes over here, and the more granular data allowed us to go in and really understand which companies and which sectors had access to some liquidity sources that were enabled by the tax changes. And that would not have been available if we had to go through these reports manually. But because they were structured, our data scientists and academics could go in and really zero in and pull that information out very quickly and then present that to the policymakers to help them with their decision assessments. So that's an example of the more granular data really having a short-term value during this recent COVID scenario.
It's a really good example, Mike, and in many ways you can look at the data. It can also help companies upfront validation. There's actually a system in, I won't go too technical on this, in the IFRS taxonomy, which enables you to ensure that things not only add up, but sort of cross-reference and everything else. One of the questions that has come through is how ready are software developers in Australia for the adoption of digital financial reporting? And I don't know if anyone wants to tackle that. I mean, obviously, we've got software developers who are providing products internationally. So any insights from any of our panelists? Maybe James, because you've actually done it.
So as software has been developed in Europe from a IFRS tagging perspective for lodgement there, those software providers, there's a number of them who have developed software that can be used for inline tagging, and those products are available in Australia.
So that's great, because there are products in other jurisdictions, you're right, with the IFRS taxonomy, and some of those are companies that operate in Australia as well. We're conscious that it's never been a real question for software developers. If they can see the demand, they'll come to the party. So I don't know, Mike, your experience in the US, I assume it happened pretty quickly after you mandated.
Yes, and I think the software community continues to mature and expand because they see the opportunity for kind of really attacking what I've perceived in my prior life as what I call the manual last mile of report assembly and review. So companies spend lots of money on their consolidation systems and their data warehouses, but that last mile of getting the information out of those systems and into a report is typically done in a Microsoft Office type of environment. And so any methods and tools to begin to streamline that process and make it more collaborative, more transparent, for the company personnel and their advisors, whether it's legal counsel or auditors, that last mile is really an area for, I think, a lot of process enhancements to the controls, the transparency, the collaboration. And so we see that as where the vendors are spending a lot of time with their value proposition. And the XBRL piece, the structuring piece, is just part of that entire automation effort.
Thanks, Mike. There's a question for Peter, which is, you talked a lot about benefits and your perspectives on the use of the information, but with your academic hat on, can you see opportunities, probably asking the obvious here, for academics in terms of some of your research work in having tagged data on a consistent basis and so forth?
There'd be enormous advantages, so I'll get the self-interest out there. So, for example, I've done a lot of work on impairment, but to clean up the data sets, we had a lot of hand collection from annual reports to actually identify all of the impairments, because they're often aggregated with abnormals in databases. For work where we've looked at the transition to AASB 15, that involved a lot of hand collection of data. If that was tagged, it would have made life much easier for me, and to be able to work out much more effectively what were the impacts of transitioning. And in relation to AASB 16 on leases, I think that if you looked at the US example, there was providers who used the XBRL reports in transition to the US equivalent, and they developed quite sophisticated programs to identify the impacts of transition on particular firms. And that would be equally useful in Australia to evaluate the impact here, not so much for as a commercial product, but as just to understand how the accounting standards are working and whether they're having the impacts that they're expected to have. So I would think I would have died and gone to heaven if I had XBRL data.
All right, we've got time for just one more question. If you had your way and you were the legislators trying to decide who, if you're going to mandate, should be subject to digital financial reporting requirements, who would you choose? Would it be large listeds, or all entities lodging financial reports with ASIC? Any takers on that one?
I'll jump in first. I think that it should be all listed entities in the first instance. And the reason I say that is I think the benefits would be greatest for the smaller entities who are subject to less coverage. And after that, you'd then move on to reporting entities who lodge reports with ASIC. And that probably does mean that ASIC does become the repository for these digital financial reports, and which are accessible by the public.
Yeah, I should clarify, when I was talking about a repository before, we'd already made on a voluntary basis the financial reports available for download. We just wouldn't have a big database at the moment with all the data in one place, so you can look at revenue across all companies or whatever. I think Anne wanted to add something.
Yes, thanks, Doug. I agree with Peter that the listed companies is the place to start, because when we talk about the costs and benefits, when we're talking about the benefits today, we're talking about getting the information out there to a range of investors. So that seems the starting place. But your question makes me think about the other entities in Australia, especially because we know Australia is a quite unusual situation where there are other entities than the private companies that use IFRS. So I'm thinking about public sector and not-for-profit. So it'll be interesting for people to look at either within Treasury, within ASIC, within the AASB, to look at where the digital benefits are for the other entities that are not the IFRS, the private stock market listed entities, but other entities. And I know that there has been some initiatives around digital reporting, for example, in the charity sector, where Australia has endeavoured to gather information in a very simplified way that has been electronic for the lodgement of information in a not-for-profit sector. So I think in Australia, there's also other sectors to think about, but that's way down in the future. I'd start with the listed companies. Thank you.
Okay, thanks, Anne. No other takers on that one at the moment? Okay. All right. Well, I'm conscious of the time, so I'd start. I'd like to thank firstly all of our speakers and their panelists for their views and insights. I found the session very valuable and learned from it. So I hope our participants have found something useful to them out of the session as well. Certainly our speakers and panelists have highlighted the benefits from digital financial reporting. I'm not going to repeat them now. And also the benefits not only for other markets, but the opportunities for Australia. They've also touched on the implementation costs and the opportunity to learn from some of the experiences of those in other countries who've already implemented it. So in some respects, there's a benefit in not being the first. We'll send, obviously, a link to the actual session today, the recorded version, to everyone, along with the slides. We'll probably clear with the panelists first that they're okay for us to do that. And I'd also like to take the opportunity, particularly to thank a couple of people at ASIC who've put in a big effort to make this happen. Firstly, Bin La, and also who you've heard from today, Slav Kucharski. So their efforts have been instrumental in making this happen, so thanks to them. Anyway, that brings our session, our webinar today to a close. So thanks again to everyone for the presentations and the panel session, and also to our participants and for your very good questions. And I wish everyone a good day. All the best.